Welcome to the world of fixed assets. These are the backbone of your business, but understanding their accounting can be a real head-scratcher. Don't worry, I'm here to break it down for you. Today, we're diving deep into the world of fixed asset journal entries. Let's get started. Before we jump into the entries, let's quickly recap what fixed assets are. Fixed assets are long-term tangible assets that a company owns and uses to generate income. Think of them as the backbone of the business that stick around for more than a year. These aren't things a company plans to sell quickly, like inventory. Instead, they're things like buildings, machinery, and vehicles that help the company operate. Because they lose value over time, accountants spread out their cost over their useful life, which is called depreciation. The first scenario is acquiring a fixed asset. When a fixed asset is purchased, the entry depends on whether the purchase was made in cash, on credit, or through financing. If purchased with cash, here is the journal entry. If purchased with credit, here's the journal entry. If purchased with loan, here is the journal entry. Additional costs directly attributable to bringing the asset to its intended use, e.g., installation, transportation, should be capitalized. Here is the journal entry. Depreciation represents the allocation of the asset's cost over its useful life. Here is the journal entry. If a fixed asset's carrying amount is higher than its recoverable amount, an impairment loss must be recognized. Here is the journal entry. If a company uses the revaluation model, an increase or decrease in the asset's value requires adjustment. Here are the journal entries for both scenarios. If an asset is improved or extended, the cost is capitalized. Here is the journal entry. Routine repairs and maintenance costs are expensed, not capitalized. Here is the journal entry. If a company expects to incur costs to dismantle or remove the asset at the end of its useful life, these costs should be recognized as part of the asset's initial cost. Here is the journal entry. When a fixed asset is sold, scrapped, or retired, the asset and its accumulated depreciation must be removed from the books, and any gain or loss is recognized. When a fixed asset is sold, if the cash received is more than the asset's net book value, in other words, cost minus accumulated depreciation, record a gain. If less, record a loss. Here are the journal entries for both scenarios. Here is the journal entry when a fixed asset is scrapped or retired. And finally, let's look at reimbursement on an insurance claim. In the first scenario we look at is insurance reimbursement with a gain. Here are the journal entries. In the second scenario, we look at insurance reimbursement with a loss. Here are the journal entries. And there you have it. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more accounting tips and tricks.